Welcome to this very special episode of Investor's Guide. You're watching ET Now. We wish you and your family a very Merry Christmas. And as this year draws to a close, it's time for us to take stock of our investments. Now, if you've been following this show regularly, you would know that we designed mutual fund portfolios for different age groups back in June 2009. We have hypothetically been investing 10,000 rupees in these portfolios every month since then. And this week, we're going to revisit those portfolios and see how you're doing. Let me bring in Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who designed these portfolios for us. Dhirendra, thank you so much for joining us on the show, and Merry Christmas to you. Thank you for spending time with us this weekend. Dhirendra, let's begin with our first portfolio. This portfolio is designed for a young person who's 25 years old, just starting out in his career. The idea behind this portfolio is to seek aggressive returns from the stock market. But remember, if we assume you're 25 years old, we're also going to assume you're going to leave this money in for at least 20 years. The portfolio has 5 funds. It has the DSP BlackRock Short Term, the IDFC Premier Equity Plan A, the Quantum Long Term Equity, SBI Magnum Emerging Business, and UTI Opportunities. Of course, this portfolio has given us an annualized return of 13.17% every year for the last 3.5 years. Dhirendra, this is impressive, but would you like to make any changes in this portfolio?
No, with this portfolio, I think, we are more than fortunate because one is that each and every fund which we picked about 1.5 years back, this portfolio underwent a rejig, and these funds have proved to be blockbusters since then. So, I would not like to, take credit for this, but yes, recent month performance has actually put it in a far better shape in terms of numbers. No, not now. I would like to stay put exactly the way I am. These funds still look compelling. They are a very good combination. All of them put together make an excellent portfolio, excellent aggressive portfolio, and even our most this aggressive portfolio, which what we are calling is not that aggressive when it comes to a lot of investors taking their making their own bets, in a sense that it still has 10% allocation to fixed income. The diversification across all segments of the market, it still has about about 30% into large caps. So it is aggressive relative to our other portfolios, but looked at it in isolation, it can be punchier still.
Well, Dhirendra, we must talk about the SBI Emerging Business Fund, 40% return since October last year. Tell us what's making this fund such an outperformer, and do you expect it to continue this performance in the coming year?
It is an aggressive fund, and it's a very risky fund. If market gets into a rough weather, this fund will suffer, and it will suffer more. It can also suffer in a rising market because the fund manager is taking bets with an understanding that if it works out, it will be a multi-bagger, or it will not. Or it will be a disaster. As of now, I think this is having a good run, and one should ride it. And one should be looking at this particular position, Magnum Emerging Business, in this portfolio. If it will have a bad time for 6 months, I will exit this fund.
That's our aggressive portfolio. It's given us 13.17% annualized returns since June 2009. I'm going to give you a quick recap of that portfolio. The DSP BlackRock Short Term, IDFC Premier Equity Plan A, Quantum Long Term Equity, SBI Magnum Emerging Business, and UTI Opportunities. Our second portfolio is designed for a 35-year-old with a long-term horizon. It's given us a return of 6.7% annualized over 3.5 years. The portfolio has 5 funds: the FT India Dynamic PE Ratio, the HDFC Mid Cap Opportunities, ICICI Prudential Discovery, Quantum Long Term Equity, and UTI Dividend Yield. Dhirendra, 6.7% could be a little disappointing if we compare it to our other portfolios. Are you happy with that return?
No, I'm quite pleased with this, and I'm still very hopeful that if the market's momentum carries on for a short while, then these numbers will change very rapidly. It's a little disappointing, but going by the kind of stability it has, the kind of stability with which it has been able to give this deliver this return. And also we have an opportunistic position in terms of, we are approaching the allocation to fixed income through the FT India Dynamic PE Ratio Fund. Our position in UTI Dividend Yield Fund and HDFC Mid Cap Opportunity Fund it has not been as good as it, as it was expected. But I would go through a full market cycle with this portfolio itself.
Your quick recap for you: FT India Dynamic P Ratio Fund of Funds, the HDFC Mid Cap Opportunity, ICICI Prudential Discovery, Quantum Long-Term Equity and UTI Dividend Yield. This is our portfolio designed for a 35-year-old. Our stable growth portfolio is designed for a 45-year-old. Now, this is the simplest of our portfolios. 4 balanced funds. It's meant to be easy to manage as well as tax efficient. I'm going to run through the funds. There's the DSP BlackRock Balanced, the FT India Balanced, the HDFC Prudence and Reliance Regular Savings Balanced. The money is equally divided among all 4 funds. This portfolio has given us 8.3% annualized return over the last 3.5 years. Dhirendra, for the 3rd year in a row, this portfolio beats our growth portfolio. Is there a reason why it manages to outperform more aggressive portfolios?
Yes, I think, periodic and disciplined rebalancing which happens automatically in these portfolios, because these funds, they remain 70-30, 70 into equity, 30% into fixed income, and they keep it that way every month. So in the interim, they are able to capitalize on gains in equity, or move into equity when if it goes below 70%. So that, I think, is translating into more consistent performance. But if we are ever faced with a secular bull run, then it will not be the case.
All right, steady, stable returns also from the Reliance Regular Savings Equity. That's the top performer in that particular portfolio, given us 10% annualized return. Tell us what makes this fund such a strong performer.
These returns keep changing, and what has happened in past 3 months, the market propelled by the mid and small caps, that is driving the performance of this fund. But the kind of investor who is attracted to a balanced fund, or the kind of investor for whom a balanced fund is suited, he's looking at far greater stability, and this fund as well as HDFC Prudence may be a very undesirable. They perform very well. Their long-term performance is very compelling, but they can be very disappointing if we are ever faced with even a milder 2008.
The funds in this portfolio: DSP BlackRock Balanced, FT India Balanced Fund, HDFC Prudence, and the Reliance Regular Savings Balanced Fund. Of course, we know that that fund has given us 8.3% returns over the last 3.5 years. Now, what is a Christmas show without a few gifts? As Christmas gifts this year, each of the experts on this show has an investment tip that will make your new year more fruitful. Here are Vishal Kapoor and Gaurang Shah.
We would be at Geojit BNP Paribas would like to wish all the viewers of Investors Guide a Merry Christmas and a happy and a prosperous 2013, and hope that your investments multiply many folds going forward from here on. So happy investing, and hope that you make good return for the year 2013. We believe going forward in the next year, and the theme is going to be the performance-wise sector really. We believe banking, private sector, financial services is going to do very, very well. We expect the rate cuts to come in from Reserve Bank of India, and this is going to improve the loan disbursement process and the quarterly numbers of the banking sector to a great extent. So the bias is going to be towards private sector banking, and of course followed by it with financial services.
See, Christmas is a time of the year when you want to give and spread joy. And one thing I'm doing this year is helping someone who's a sole bread earner, known to me, who cannot afford basic term assurance, which will just cost maybe a few hundred or maybe 1,000 rupees, as well as a basic health cover, which will again be similar. So in about 2,000 rupees, you could be gifting someone the joy of being covered and the protection of being covered for both term and health, and therefore adequately securing at least the year in terms of making sure that there's no financial calamity that impacts his or her plan for that year.